Kohl's and Dick's Sporting Goods adding to the flood of companies raising concerns about the U.S. consumer. Comparable sales at Kohl's are expected to drop as much as 6% this year, far exceeding Wall Street's projections to the downside there. And then Dick's also disappointing with the low end of its sales forecast and earnings guidance trailing the average analyst's estimate. Here with more, we got Michael Baker with D.A. Davidson as a managing director and senior research analyst. Michael, it's great to speak with you. I know that you highlight here that those comp sales were the strongest in 2.5 years here, but it seems like there's still concerns about the stock. Would you be buying some of the weakness that we're seeing today?
We would be, yeah, absolutely. Dick's had a very good quarter. Their guidance is below consensus. 0% of the companies that I cover have guided to numbers above consensus so far this earnings season. Given the environment and the uncertainty, the policy rifts, as we're calling them, for rates, inflation, FX, and tariffs, it makes sense to guide conservatively. That's exactly what we saw here. We just got off the phone with the CEO, off the call, I should say, and they are not seeing any concern with the consumer at all. This is just guiding, in their words, appropriately or prudently cautious. That does make sense, and so we would be buyers here. This has been a really good stock over the last couple of years, but still one of the cheapest in our space. And so we like it on the secular growth story from here.
So what are they blaming the weakness on, and what is justified in that excuse?
Again, we're not seeing weakness. They coughed at 6%. They did guide to a lower number, but that's being prudently cautious. A year ago, they guided 2024 to 1 to 2% in terms of comps, and they just came in at 5.5. They beat their earnings guidance by a full dollar. That's about 8%. So it's just the game sometimes that companies play where you want to guide conservatively. It makes sense to do that, but you want to set a bar that can be beaten, and we think that's exactly what's going on here. Now, sometimes when companies guide below, it's because they're seeing a slowdown, and we need to know that, but that's not what's happening here in our view.
So then why do you think that the market is so negative on the stock this morning? I mean, we are seeing a slew of companies saying that they're lowering their guidance off the back of concerns about the economy, about tariffs. I hear you saying that Dick's is the exception to what's starting to be a trend.
Yeah, I think the stock's down for a couple reasons. One, the easy analysis is, okay, the guidance is below the street. The interpretation is that they are seeing weakness. You would have had to have listened to the call to understand that's not really what's happening. Secondly, there's a lot of signs that we might be going into a recession. So regardless of what they're seeing now, this is a consumer discretionary name. So that sector has been under pressure. So in a way, we think the weakness could be really irrelevant relative to the numbers that they put up today. It's just what we're seeing from broader sector rotation outside of these kind of names. But again, we think that's an opportunity because we think it is down more than it should be given the strength in their business and the long-term growth outlook.
And they're also spending to grow, utilizing the cash that they do have on the balance sheet to grow, Michael. How do you think that they can do that in a way that is effective for growth for the company and more long-term?
Right, so the SG&A dollars will be higher and the CapEx will be higher, but that's because they're opening a lot of new stores. They've found this great new concept called House of Sports, which is really a showcase type store, a big giant store. It's working really well. They've invested in some what you might call alternative businesses. One that we're really impressed by is Game Changer, which is kind of a software as a service type of initiative. That's growing about 45% year over year with very, very high margins. They're investing in retail media that we're seeing from a lot of companies. So they're investing SG&A dollars, but it's driving higher sales and higher gross margins. And so we think that's a favorable trade-off.
All right, Michael, we got to leave it there. Thank you so much for joining us this morning. Appreciate it.